So now we'll start with overtrading concept. Overtrading refers to the state when a business is carrying out transactions at a high speed which cannot be supported by its working capital. So overtrading is usually faced by companies which are in the growth phase. That is, they are rapidly growing more than what their capital could support. This means that the increased number of transactions are putting pressure on the cash flow of the business, thus giving risk to insolvency. The problem of overtrading is very common to businesses, but it severely affects the following businesses. So startups, small and medium sized enterprises, are rapidly expanding businesses. So these are the most vulnerable kind of companies which get affected by overtrading. So we look at how like overtrading happens in a company. See, the inventory for a company is bought on credit from the supplier and it is sold to the customer on credit. So once it is sold on credit, the debtor will pay the company cash after a month or two. So once he has given cash, the company will receive the cash. And this cash is paid to the suppliers and it's paid as salary and it is paid as rent for the company on a month-on-month basis. So again, what happens? The circle continues. This circle keeps on continuing, but there might be problems. For example, the company might again buy goods on credit and it sells goods on credit. But this time, the cash is either delayed a lot by the investor. So if we give them a 2 months credit period, they take something like 4 months credit period and they pay in a much more delayed manner. So what happens because of this? Because of this, the cash is received in a very, very delayed manner. Rather than receiving in 2 months time, the company might even receive in 4 months time from the credit customers. So now the company has to pay salary. There is no other go because or else the employees will quit. Rent has to be paid or else we have to quit the office. So the company negotiates with the suppliers to delay the payment furthermore. So the payment to the supplier is delayed. So if the customers are going to delay, we have to delay our suppliers. So in order to overcome this, what we can do is we can raise an overdraft. So we can go to a bank, raise an overdraft. Now we'll have sufficient amount of cash. With that cash, we can pay our suppliers. Okay. So the suppliers are not hurt now because we have raised overdraft. But this cannot be done for a long time because if the customers are going to keep on delaying, for example, rather than 4 months, they are now trying to delay it for another 1 month. So it comes to a 5-month delay. So now what happens is we have to still pay our salary, our rental, our suppliers. So we will keep on getting more and more overdraft. For example, we might start with an overdraft of 1 lakh. So then the overdraft goes to 2 lakh. Then the total overdraft even crosses the 3 lakh limit. The bank has set a limit usually. The maximum limit might have been 3 lakh and we would have reached the maximum limit. So the bank will not further provide any overdraft cash. So what happens? So once the overdraft limit is reached, we cannot buy inventory on credit because we have not paid our suppliers and it's not possible to sell on credit. But the debtors would have risen to a huge amount. So proportionally, they would have become a large amount of debtors and our cash position would have been totally reduced. We cannot pay our suppliers the salary or the rent. And finally, our inventory will be like stopped and they will not supply us any more of inventory or goods. So what happens is the entire operating cycle comes to an end and now the company has no other choice but to go for some other sources of finance. Okay. So what happens when overtrading is occurring? There will be an increase in credit sales. there will be more cash or credit needed. Okay, more cash or credit needed. Suppliers stops inventory on credit. Overdraft limit is reached. Some credit sales will come as cash. Okay, but only some of the credit sales come as cash, and the other are just being delayed. There will not be any inventory in the company because all inventory are sold on credit. So cannot sell on credit because all are sold on credit earlier itself. So overtrading will stop the functioning of a company itself. So we'll look at what are the financial indicators that indicate that overtrading is occurring in a company. Number one, rapid increase in sales. So the sales increase for every year would be like 100% or even 200% or more than that. Gradual increase in current assets. The current asset will increase, but if you look, mostly the receivables is what that keeps on increasing, because the inventory position would have been like going down. The inventory can go down because the company has already sold a lot of inventory, and the cash and bank would be zero. Rapid increase in current liability. Why? Because all the goods are bought on credit but they are not paid, so the payables will increase, and the overdraft, bank overdraft will increase. If there's any short-term bank loan, that will also increase. Even outstanding salary or even rent will start to increase. That is, there will be a rapid increase in the dues from the company. Increased reliance on overdraft. Decline in current and quick ratios, because the denominator is much more a higher number than the numerator. So as the denominator keeps on going high, the ratios will keep on falling. So that's what happens. Increase in sales income divided by net working capital. So this ratio is called as working capital turnover ratio. Okay, this ratio will keep on increasing. So why it will increase? Because the sales will be a very high number and the working capital, net working capital, will be a very low number. So why it is a low number? Net working capital is nothing but CA minus CL. So CA will be normal, but CL will increase to a high number. So the net working capital will become a very, very low number, and sales will be a very, very high number. When you divide numbers like this, what would happen is there will be an increase in the net working capital turnover ratio. That will be an increase in working capital turnover ratio. You can also find that year-on-year increase in sales, inventory, debtor, creditor, and overdraft will be high. So this is how we compute year-on-year sales. So the current sales divided by last year sales into 100, you will get the year-on-year sales. So other numbers are also calculated in this manner. From an exam point of view, this is a very, very important topic, because you should be able to work out these financial indicators and then indicate if a company is like in overtrading position or not. So how do we overcome overtrading position? So a company has to do these things. The problem is the company has relied too much on the overdraft and they need cash to run the company. So the only way to kickstart the company again is to increase the long-term capital of the company. How do they do that? They try to issue new debt finance or new equity finance. So both of these are long-term finance. Stopping rapid expansion of sales till company stabilizes. So if the company is not able to keep on like churning out their business, what they should do is they actually have to stop their sales, okay, and especially the credit sales. If it's going to be cash sales, it's very good for the company. This is very good for the company, but this is very bad for the company. So the company has to stop credit sales. Increasing collection of receivables, as the debtors are not paying promptly, okay, we have to chase them and we have to get the payment from them. We have to reduce inventory. but inventory would have been already reduced because we would have sold it to our credit customers. But if it's still there, then we have to try to monetize it, creating strong credit controls. From here on, we should not be like selling too much on credit. Shortening the manufacturing cycle. So if the company is a manufacturing company, then the company has to shorten their manufacturing time. Cutting costs and improving efficiencies. So we can cut the costs here and there, and we can try to improve the efficiency. But the most important point of all these is to immediately solve the overtrading problem, the company has to go for long-term debt finance or long-term equity finance. So we'll move on to the next topic. It's called as inventory management. Inventory is an accounting term that refers to goods that are in various stages of being made ready for sale, including inventory can be a finished goods, inventory can be work in progress, and inventory can be raw materials. So all of these are referred commonly as inventory. Inventory is generally the largest current asset in a company. Items expected to sell within the next year a company has can be classified as an inventory. For example, if you take a real estate company, for them the land and building is a inventory. If you take a supermarket, for them all the chocolates and biscuits, those are the inventory. Or if you take a manufacturing company, assume that a cell phone manufacturing or a mobile phone manufacturing company, the mobile phones are the inventory. So it's not about the value of the asset, whether the company is trying to sell the asset within a year. So selling the assets within the next year forms the basis of inventory. So why does a company need to have inventory? Inventory is required to avoid loss of sales, because the customers might come and ask, but the company, if it doesn't have any inventory, then they lose their sales. So for that purpose, they should always have some inventory. To cope up with variability in sales, we don't know when the sales will be high or when the sales will be low. So we should always have a mediocre level of inventory in our company. To gain quantity discounts, for example, if our supplier says if you buy in bulk, you will get some discounts. So what we do is we try to buy in bulk, and we then create raw material inventory. To reducing ordering cost, if you buy in bulk, the ordering cost is lower. Again, this helps in creating more raw material inventory. To achieve efficient production run, so if you're going to produce a small batch of items, then it is very costly. If you're going to produce an ideal amount of items or ideal amount of products, then that might lead to an efficient production run. So we are operating the machine at a efficient level. So because of this, our work in progress inventory and finished goods inventory will become high. To keep production during lead times, lead time is the difference between the date at which the order is placed with the supplier and the date at which the good is received. So if we are going to order this today and we are going to receive the goods 3 weeks later, okay, then the 3 weeks becomes the lead time. So how will we keep producing during the 3 weeks? We have to have a raw material inventory. Okay, with that raw material inventory, we can keep producing the goods. So what are the costs of inventory? Cost of high inventory levels. If you are going to have high amount of inventory, these are the costs. Number one, the purchase cost, then the holding cost. So holding cost refers to storing the inventory, then administrating the store or warehouses. There is a risk of theft or damage or obsolescence to the inventory that is being stored in the godown. If we have low levels of inventory, that would lead to stockouts. So that is, we won't be able to sell goods when the customer asks. So because of this, we lose our income, that is lost contribution. If we don't have sufficient amount of raw material inventory, then we have to stop production. So for example, if in a car manufacturing company, if they don't have the engine at all, then the entire production has to be stopped, because without the engine the car cannot be produced. Or the problem is, if you have low inventory, we can still get the orders, but we have to put some emergency orders. This has a high cost. So it's something like immediately ordering. Okay, so for that immediate order we have to pay a high cost. If we have if you have low levels of inventory, that will lead to high reorder costs and high setup cost. So high reorder costs is, if you're going to buy in small batches, okay, then we have to do a lot of reordering, so that increases the cost. For example, if the company wants to buy 1000 units of raw material, if they buy it in one batch, it is very cheap in terms of reordering cost. But if we are going to hold low levels of inventory, then it means that we are going to buy just 100 units of raw material. That means we have to 10 times we have to order. Okay, we have to order it 10 times. Because of this, the ordering cost becomes very high. Okay, so that is the cost of inventory. Then there's also something called as a setup cost. So setup cost is every time we are going to set up the machine to produce the products. Okay, so if you're going to produce a small batch of for example, a company wants to manufacture 1000 t-shirts. Rather than producing 1000 t-shirts at a quick stretch, what they do is they are like manufacturing in batches of 10. Okay, in batches of 100. So the machine has to be set up for every 100 units. So the machine is set up for 10 times, and the cost of setup becomes very high. Loss of quantity discount. So if the supplier says, if you buy in 10,000 quantity, we'll give you a discount, but the company says we will buy in thousands quantities. So because of buying low levels of inventory, they won't get the quantity discount. So there are like costs which are associated with having a high amount of inventory. There are also costs which are happening with low amounts of inventory. So the company has to strike a balance between the both. Okay, so what is the ideal level of inventory? For that we have some equations and problems. So we'll have a quiz. Which of the following tend to increase the amount of inventory that a company has? So cost of holding inventory decreases. So if the cost of holding decreases, will we increase the amount of inventory? Yes. So we'll have an example. Earlier it took 1000 rupees to store 1000 units, but now it takes only rupees 500 to store 1000 units. So what we'll do, we'll try to increase the number of units stored. So cost of holding inventory decreases, it will always tend to increase the level of inventory held. So this is the right answer. Variability of sales decrease. Only if there's a high variability, we have to hold more amount of inventory. When the variability decreases, we can hold less inventory. So this is a wrong answer. Cost of running out of inventory decreases. So if the customers are not going to ask, and then we don't need to open. Okay, if the customers are not going to ask for goods, then there's no cost of running out of inventory. So this is not the right option. Lead time decreases, the time between ordering the good and receiving the good. So earlier it took 2 weeks, but now it just takes 2 days, means we just need to hold 2 days of inventory, not 2 weeks of inventory. So these options are wrong. Okay, so all these options actually decrease the inventory, decrease the need for inventory. Okay, so A should be the answer. The answer is A. So the next one is EOQ. So EOQ is the economic order quantity, which refers to the optimal ordering quantity for an item of inventory, which will minimize the cost. So we look at the chart to identify like how the EOQ works. So on one side we have the units, the number of units, and on the other side we have the annual cost. Okay, so there are like 3 lines here. we'll start with the holding cost. Holding cost is storage cost. So the more the units you store, the more will be the storage cost. The ordering cost is, if you're going to order a large number of units, okay, the ordering cost will fall. If you're going to order less number of units, the ordering cost will be high. Okay, so the ordering cost keeps falling with the more the units you order. Okay, so that's what happens. But now the problem arises, if you're going to hold more units, holding cost will go up. But if you're going to order goods in bulk, you will get quantity discounts, as well as the ordering cost goes down. So somewhere there has to be a trade-off between this. That trade-off is what EOQ tells you. So the lowest point when you add both the holding cost and ordering cost, okay, this point refers to the EOQ. So EOQ tells you what is the optimal ordering quantity, how many units you should order in each batch for an item of inventory, which will minimize the inventory cost. Okay, so that's about the EOQ. So what is the formula for EOQ? So EOQ formula works like this: EOQ equals to square root of 2AB divided by CS, where A is the annual demand for the raw material unit, B is the ordering cost per order, C is the cost per unit, and storage cost is a percentage. So we can also find out like what is the total number of orders that you have to make in a year. So annual demand divided by EOQ gives you how many orders you have to make in a year. So what is the frequency of orders? The frequency orders you can find 365 or 12 divided by the number of orders per year. So this will tell you what is the frequency of order. So we look at EOQ versus quantity discounts. So sometimes what happens is bulk purchase discounts are offered by the supplier if the ordering is in large quantities. EOQ gives the optimum reorder quantity. So there is now a trade-off. If you're going to buy in bulk, then you will get quantity discount. But if you buy in EOQ, you get the lowest ordering and holding cost. So which one you should do? You should select. Should you buy in bulk, or should you should you follow the EOQ number of units to be ordered? So should the bulk purchase be done or not? That becomes a crucial question. For that we have some problems. For that we have some steps. Step 1, calculate the EOQ for usual purchase. If the EOQ is below the quantity qualifying for a discount, calculate the total annual inventory cost arising from EOQ. For example, the EOQ is 1000 units and the bulk units that has to be bought to get the discount is 2000 units. So it means that EOQ says you have to buy only 1000 units, but the supplier says buy 2000 units. Okay, as EOQ is lower than the required threshold of 2000, so now you have to work out what is the total cost of ordering and holding EOQ items. So that is the second step. Let's look at the third step. Calculate the total annual inventory cost using the order size required to obtain the discount. So this is the 2000 units that we had in the example. Compare the cost of steps 2 and 3. Select the alternative which gives the lowest cost. Okay, so first what you do, you calculate the EOQ, then you apply this logic. Okay, if the EOQ is less than the bulk quantity, then you have to do step 3 and 4. So step 3 you have to calculate the cost of holding inventory and ordering for EOQ for this 1000 units. You do the same for the bulk discount of 2000 units. Whichever is lower, you are trying to compare and you choose among step 2 and 3. So that's about EOQ versus quantity discounts.